Hello, Tom. Nice to meet you. See you here at the London MoneyLive conference. How are you?
Very good. Thanks for having me.
How is the conference for you?
Good. This is the second day. Yesterday, I had a speaking engagement about scaling up on fintechs and how they can work with the traditional banks, as well as how to grow, get venture capital, private equity, or exits. It was a great meeting.
Okay, how they have to work with traditional banks?
Sure. Well, it's a dual edge. So first and foremost, they really have to understand what is the product and the problem that they're trying to solve for. A lot of times they build a product, then they try to sell it. And then they find that customer acquisition cost is too large, or the time to sell into a traditional bank is going to be 12, 18 months. They should work backwards, understand what are the current problems that the banks are willing to buy tomorrow. Take that. So sell it first, then build it. On the banking side, some of them need to mature. NatWest has accelerator programs. Barclays has accelerated programs, but there's a lot of society, so call them credit unions and small banks that need to find ways to be forefront of the market and have programs to work with fintechs.
From your experience, what are the partners for the companies to be successful in capital raising or big exits?
On the success side, to get a capital raise, you have to show revenue growth, you have to show volume growth, and ideally, if you're a scale up, you need to have a pathway to break even or you're already profitable. Then when you go to markets and you look at investors today, they're absolutely going to be interested in fueling your growth. Not every company is going to have a hockey stick curve and call it venture funding eligible. On the exit side, it's those components, or simply they've been running a business and call it they're exhausted, right? They maybe have had a large valuation 2-3 years ago, and now they're not going to be able to repeat that valuation, or they really need a lot more capital to grow, and they may be plateauing. That's also the signal for an exit.
When you're doing an exit, if you have to work, you're preparing your company for a big capital injection. You just have to do a lot of due diligence. You have to rethink about maybe some strategies and so on. And often, from my experience, there were projects when we were preparing for capital raises. We observed that some hidden gems was founded in somewhere in finance team or in technical team. Usually, from your experience, what are the most popular things that people are finding during due diligence?
So I think any type of scale up looking to do a transaction, whether it's growth capital or exit, 12 months before, they need to start preparing for it. So besides the financial metrics, the growth metrics, the structural topics that they need to think about is the cap table, right? Who's on the cap table? What type of cap table cleanup they may have? 2, the legal entities. Do the legal entities have governance? 3, do the legal entities have audits, right? So the quality of earnings is also an important aspect, because if they're not audited, then how do you know the earnings that the company has are legitimate? I would say those are probably the top 3 that scale-ups need to prepare for at least 6 to 12 months before a transaction.
As an example, you were coming in a company. At what metrics you specifically look that proves that exists a real growth, not a hidden one? Because sometimes people try to pump the companies with capital or amount of transactions or volume of transactions. How do you see the patterns that not is legit? Because we are sure that those is legit, but grow is a natural one, a real one.
Sure. So couple things. As an investor, and I'm also an investment banker, so I support and advise these firms on these exits. What does quality of earnings really mean? So when we think about revenue, what is the client concentration of that revenue? What is the cohort? How are you pricing it? What is the contract stickiness for that revenue? The other thing is the actual percentage of growth. If a company is growing 10, 15%, you know what? There's going to be a specific investor for that versus somebody growing 20 to 30%. Is it B2C? Is it B2B? B2B has much longer sales cycles. So those are, I would say, at a minimum, the key levers that are important to determine the quality of the growth. And then also, the management behind it, have they done this before? How structured are they? The processes, the governance, and so forth.
It was the same 5 years ago, the same metrics you were looking, the same things you done 5 years ago, like today, or it's totally different?
No, 5 years ago, it was a dream world. I think if you think about 2019, even 2021, the growth metric was field growth at all costs. And so you had both explosive volume of and primarily this is B2C, primarily explosive growth of volume. And then economy started to adjust and slow down in 2023, 2024. Those reveal like the customer acquisition cost too high, lifetime cost of the customer too high. And at the time, they call it the 2019, 2021 vintages. They paid premiums higher than any time probably in the past few decades. Today, investors were burned from that. And also there's just a lot of prudent investors that didn't want to get caught up in this type cycle, and they just look for strong stability. Again, going back to pathway to break even, already profitable, and some consistent revenue with a distributed client base.
What advice you'll give those who want to attract investments or maybe an exit?
Don't follow the hype, whether it's AI, stable coins. Solve a problem, right? Identify what the problem is, but don't identify it in a vacuum. Sell it first. Talk to customers. Talk to the customers that are going to buy it. Find out what's the problem that they want to solve for, two, what they're willing to pay for, and how long is it going to take for them to buy it. Then reverse engineer it. Say, okay, if they're going to buy it for 100 and it's going to take 6 months, I need to build it for 25. I have my profit margin and I know what the sales cycle is. Reverse engineer it and then go to market with that base. Otherwise, if you build it and try to sell it, you're going to keep pivoting and pivoting.
Thank you very much for your insights and be here. Have a nice day.
Yeah, cu plăcere. Thank you.
Bye-bye.
Bye.